Stop for a moment and focus carefully. What has just happened in the Middle East is not a routine exchange of strikes. It is not a symbolic show of force. The confirmed targeting and removal of Iran's supreme leader marks one of the most consequential escalation points in modern regional conflict. The question now is not emotional, it is strategic. Did this strike strengthen US and Israeli objectives? Or did it structurally increase the probability of a longer, more dangerous, and more expensive war? This is the Economic Times Now War Intelligence Brief. We are going to walk through what is confirmed, what is being assessed, and what the economic transmission channels look like for American households and global markets. Let's establish the fact baseline. Over the past 48 hours, the United States and Israel conducted coordinated strikes across multiple Iranian targets. Iranian state media has confirmed that Supreme Leader Ayatollah Ali Khamenei was killed during those operations. That single event fundamentally alters the structure of decision-making inside Iran. In highly centralized political systems, authority is concentrated. Removing that authority does not automatically create stability. It can fragment command structures, accelerate hardline consolidation, or eliminate negotiation channels that previously existed behind closed doors. That is the first strategic uncertainty. Was the Supreme Leader the central brake on escalation, or the engine driving it? We do not yet know. But what we do know is that leadership decapitation dramatically increases short-term volatility. Iran's military response has already extended beyond Israel. Missiles and drones have targeted US positions and allied host countries across the Gulf. Airspace closures and heightened defense postures are spreading across the region. The operational environment for American personnel has changed materially. This is no longer a contained exchange. Now we turn to what matters directly for American households: energy. The Strait of Hormuz remains the central economic risk variable. Roughly 20 million barrels of oil per day, approximately 20% of global daily consumption, normally transit that narrow corridor. Even partial disruption creates an immediate pricing shock. While a full closure has not been independently verified at scale, maritime tracking data indicates significant vessel hesitation and insurance repricing. When insurance premiums spike and risk rises, tankers delay movement. Markets respond before physical shortages appear. Brent crude has already shown sharp volatility in over-the-counter trading. Major financial institutions are modeling oil moving into the $100 range if tensions remain elevated. In extended disruption scenarios, some analyst estimates project $120 to $150 per barrel. These are projections, not guarantees, but they reflect the risk premium now being priced in. For the American consumer, every $10 increase in crude typically adds roughly 20 to 25 cents per gallon at the pump. If oil were to stabilize above $120, national gasoline averages could move meaningfully higher, potentially toward $5 per gallon in certain regions. That is the war tax. Diesel follows crude. When diesel rises, transportation costs rise. When transportation costs rise, food distribution costs rise. Analysts estimate that a sustained oil shock could add several percentage points to grocery inflation over a matter of weeks. This creates a policy trap for the Federal Reserve. If energy-driven inflation re-accelerates, rate cuts become more difficult. That means mortgage rates remain elevated, credit card interest remains elevated, auto loan rates remain elevated. The pressure on the middle class compounds. Now consider equity markets. Energy-intensive sectors, aviation, logistics, retail, manufacturing, face margin compression. If crude remains elevated for weeks rather than days, earnings guidance will adjust downward. Market volatility indicators are already rising, and institutional risk models are recalibrating exposure. In prolonged conflict scenarios, recession probabilities increase materially. Energy analysts have historically described sustained triple-digit oil prices as recessionary territory for the United States. Meanwhile, safe haven flows are accelerating. Gold prices have shown strong upward momentum. Treasury yields may initially decline as capital seeks perceived stability. The US dollar could strengthen in the short term as global liquidity consolidates. But there is a second-order risk. Cyber retaliation is a known asymmetric tool in modern warfare. While there is no confirmed systemic disruption to US financial infrastructure, security agencies typically elevate defensive posture during periods of geopolitical escalation. Banking and payment networks become high-value targets during conflict cycles. The probability of attempted cyber disruption increases in war environments, even if successful execution remains uncertain. Markets are factoring in that risk. Now we widen the lens. China imports a significant share of its oil from the Gulf region. India relies heavily on Hormuz transits. Japan and South Korea also face exposure. A sustained disruption does not just hurt Western economies, it reverberates across Asia. This increases global bidding competition for non-Gulf crude. That dynamic alone can push prices higher, even absent a total maritime blockade. From a military standpoint, decapitation strikes carry historical precedent, but outcomes vary widely. In some cases, command structures collapse. In others, hardliners consolidate power and escalate retaliation to prove resilience. Iran's constitutional mechanisms have reportedly activated interim leadership structures. The system, at least institutionally, remains intact. This matters. If internal fragmentation does not occur, escalation could persist longer than initially anticipated. And duration is everything in energy markets. A one-week disruption produces volatility. A one-month disruption reshapes inflation expectations. A multi-month disruption forces structural repricing of global supply chains. We must also consider the risk of proxy expansion. Regional militias and aligned groups may increase activity across multiple theaters. This expands the target set for U.S. personnel and allied infrastructure. The longer the war persists, the greater the fiscal burden. Defense expenditures increase. Munitions replenishment accelerates. Debt issuance expands. In a high-rate environment, fiscal sustainability becomes a medium-term consideration. Now we return to the core question: strategic win or costly escalation? In the narrow tactical sense, eliminating an adversarial leader is decisive. In the broader strategic sense, removing a centralized authority can reduce negotiation flexibility and increase retaliatory momentum. The ultimate outcome depends on duration. If diplomatic channels reopen within weeks, markets stabilize. If escalation hardens into sustained confrontation, the economic consequences deepen. Higher energy prices, tighter financial conditions, weaker corporate margins, and greater stress on American households already navigating elevated living costs. This is not a moment for panic. It is a moment for disciplined awareness. Expect volatility. Expect energy-driven inflation pressure. Expect market repricing. But also expect global powers to weigh carefully the catastrophic cost of uncontrolled escalation. The world has entered a higher risk regime. Energy markets are the first transmission channel. Financial markets are the second. Household budgets are the third. We will continue monitoring tanker flows, oil futures curves, bond spreads, and volatility indices as this situation evolves. Stay informed, stay analytical, and understand that in moments like this, structure matters more than emotion. This has been your ETN War Intelligence Brief.